Okay, folks, how pro traders use technical indicators. All right, let's first start talking about what indicators do not do for you as a trader. Now, if you've recently began your journey into trading and have adopted the mindset that using indicators is the answer to everything in your analysis, this is probably going to be the most painful lesson for you, because I'm going to burst your bubble right now and tell you that's the wrong way of doing it. If you're looking at indicators that give you the decision whether you're going to be buying or selling or taking profits or not doing anything at all in trading, um, that is the neophyte or street money's perspective on trading. Okay, indicators by themselves are not beneficial. Okay, in conjunction with other things, then obviously they have their merit. But the central point in price analysis is, as a professional trader, we understand that indicators and charts do not move price and or the markets. The market and or price itself moves the charts. This is very, very crucial for you to have a proper perspective on your analysis. Before we go any further with this presentation, it's very important that you go back and review the market profiles video. If you haven't seen that module yet, I would recommend you stop this video now and go back to the Inner Circle Trader market profiles video. You can find it on YouTube, or if you're following our information presented on Baby Pips, just go to the first page on our thread, what every new and or aspiring forex trader still wants to know. On that forum, the very first page, it's an index list, and you probably found this video there. Just go through that index list and you'll see that the market profiles video is listed there. So again, it's more or less a prerequisite for this module, so if you haven't seen it, I really recommend you go back and view that one, and this module will be a lot more insightful to you. Okay, overbought and oversold. Okay, these two terms are probably the most overused in technical analysis jargon, and it sounds cool. We're talking about with our friends and family members, or at the dinner table, or at lunch. Our coworkers are impressed with our high society lingo. But this idea has probably resulted in the majority of traders' equity loss than any single indicator-based concept. The notion of whether a market is overbought or oversold somehow equates to a no-brainer buy or sell signal. Well, if this is what you're thinking coming into the marketplace and using technical analysis, you're in good company, because that's how I cut my teeth on technical analysis. I had a book sell me on the idea that it's simply overbought, oversold, and that's your way to the bank and riches. And my first trade using that concept, I lost money trading commodities, and it was the orange juice market, and it blew up in my face. So it was a very quick baptismal into the world of loss, and I realized it took a lot more than just understanding if the market was overbought or oversold. And that basically hinges on your understanding of where price is currently and where the probabilities are stacked on the higher time frames. And when you have that, it will align those locks, tumblers, on this concept, and it'll be far much easier to see real overbought and real oversold in the marketplace. Focusing on oversold in market profiles that suggest prices are bullish is optimal. Overbought in market profiles that suggest prices are bearish is optimal. Now, if that went over your head, that's okay. So let's take a look at real market examples on how we can use overbought, oversold, and the pros and cons that go along with using it. Okay, folks, let's look at an example of typical overbought and oversold, and how it can be beneficial, and also how it can trip you up as well. Okay, we're looking at the cable. This is a 1 hour chart, and I have the 14 period smoothed by 3 stochastics. That's the slow stochastic at the bottom. Okay, we have a present overbought condition on this example here. Okay, and one would reasonably expect to see a drop down in price, and we're going to scroll through overbought, oversold readings as we go through. Okay, now we're oversold. Okay, so we would expect to see a bounce higher in price. Okay, we now have an overbought condition. one would reasonably expect to see prices decline. Now we're oversold again. We look for a move higher. Now we're overbought again. Now we're oversold again. Okay, we're overbought. One would look for a move lower. Now we're oversold again. Now you see how we went from overbought to oversold, and really all we did was consolidated. So just using overbought, oversold by itself is misleading. Okay, we have to have other factors involved with our trading. But moving along, we went from a very short-term overbought to a nice precipitous slide in the cable. Now we're oversold. Okay, one could reasonably expect to see a move higher if we were just looking at overbought and oversold. Okay, so we moved a nice swing higher, moved to an overbought reading. So now we look for lower prices if we're just following overbought and oversold again. So we had small little retracement. Now we're oversold again and moved up from it to now an overbought. Okay, so now we would look for prices to move lower. But look what happened. You know, if you were using this high here, this registered and overbought, so you could have been looking to take profits if you were profitably long, okay, or if you were a contrarian and you used it as a means of getting short because you thought that market was overbought, you could have been stabbed. You could have been stabbed out with a slide move up into your stop loss and take you out of the trade. Okay, so it takes a lot more to trading than just using overbought and oversold. And we're just using a small sample size on one pair, and this is universal with all markets and all time frames, but 1 hour is a pretty good time frame to use overbought and oversold. And if you look at how we have presently on this example, shows an oversold condition. So one would look for a higher price just based on that alone, and look, you don't see that unfold. Okay, so here we're oversold again. One would look for higher prices if you were just using overbought, oversold, and again, you're wrong. Just using oversold conditions does not translate into buy signals. Okay, moving forward, we went to an overbought. One would look for now what? Sell. Well, price actually starts to move higher. Okay, and then we started going back and forth to short-term overbought and oversold, which is like a consolidation. And then finally, price slid from the 154.90 area down to 153.10, and just by using overbought and oversold, you may have been tripped up with that. Okay, so moving forward, we can see how we went from an oversold condition, okay, just using oversold and overbought. Presently, we would be looking for what to happen. Well, it registers a overbought reading, okay, so we would look for what? A slide down, okay, and this is one example where it would have moved in your favor, but look how many times you've missed some pretty sizable moves just by using overbought and oversold with no context of higher time frame analysis behind it. Okay, and then obviously moving right along, we had now a shift trading off of a key support level on a higher time frame. Now suddenly overbought and oversold will mean something and in the realm of the oversold condition, and now you'll see when oversold readings happen, okay, they are profitable, and then overbought readings no longer have any lasting impression on price action. Actually, you can see with the thumbs down indication that if you were looking for sell signals or looking to take profits, they would have been no help to you, because the trend or higher time frame analysis is suggesting now focusing on overbought is no longer as important as finding oversold readings, and oversold readings will now generate more profitable trades for you. Okay guys, price divergence. Okay, this is one of the classic uses with indicators, and it's to look for divergence between price and the indicator. Again, this has resulted in traders' equity erosion, much like the notion of a market being overbought or oversold. Now, divergence alone is useless without the higher time frame perspective. In a strong trending market, the indicators can diverge, and while followers of the indicator divergence trade on this premise alone, many, if not most of the time, it will result in a minor correction or consolidation and then resume trending. Now, using our illustration here to the right, there is a bearish divergence on the left and a bullish divergence on the right. On the left, we're going to quickly go over what a standard bearish divergence would be. The upper line here represents price, and you can see that price was able to make a higher high in this illustration. Rather crude, but it'll still accomplish the method. And if you look below at where you would have your oscillator, would be maybe a MACD, an RSI, or a stochastic, it would fail to make a higher high. That is a bearish divergence, your standard classic bearish divergence. The market may or may not trade lower on this. Okay, many times it'll just consolidate or correct and then resume higher. So don't be lulled in the thinking that just because it makes a higher high and it doesn't in an indicator that somehow equates to a market top or a significant high. It can if it's trading at a confluence of resistance and things to anticipate a market trading lower there, but by itself it doesn't mean anything. On the right, we have a standard bullish divergence where we have price here making a lower low, and comparably the indicator, whichever one you would be following, whether it be MACD, stochastic, or RSI, fails to make a lower low. Okay, so bottom line is this would look like a buy signal in divergence camps, but unless it's at a significant support level or other reasons to be buying by itself, simply because price has diverged, making lower lows but not in the indicator, means little to nothing. So it's very important that, number one, you can identify the divergence like this, but then also what we do with it when it happens is much more insightful when you have a higher time frame analysis in perspective. So let's take a look at a couple examples of divergence and the pros and cons using it. Okay, folks, we're going to look at the premise behind divergence in indicators and how it can be useful and how it can also be harmful to your trading. Okay, we're looking at the Australian and US dollar pair, and notice that we made a lower low in here while the stochastic was oversold but also posted a bullish divergence. Okay, so this low here is comparable to this low in the stochastic, and this low in here is comparable to this low in the stochastic. Okay, so we had lower low in price, higher low in the stochastic. This is a type 1 bullish divergence. Okay, type 1 bullish divergence. When you see that, you would reasonably expect to see higher prices. Okay, now we see higher high in here, so this high higher on this high, so this high is higher than this one. But notice on the stochastic we're overbought and we had a lower high. Okay, so that's a type 1 bearish divergence. Okay, higher high, lower high in the stochastic, or whatever indicator that you use in oscillators. But notice how it only had a minor correction, and then once we got to oversold readings again, suddenly, because the higher time frame analysis obviously is bullish in here, what I'm really trying to illustrate is how by looking at bullish divergence type 1 or type 2, which we'll learn in a moment, that will be more beneficial to you than looking at bearish divergence. Bearish divergence, like in here, would just indicate a possible correction and pullback into what? To a higher time frame support level or an old high, some consolidation. We had some consolidation in here, and that's basically essentially what it pulled back to, and this old high in here it found support at and then resumed its up move. We had price have a lower low here, okay, and we had bullish divergence, type 1 bullish divergence, which is lower low, higher low, and we're oversold. So suddenly now you'll see an extrapolated move higher because we're in sync with the higher time frame. And we have again a type 1 bearish divergence where we have a higher high here, lower high here, okay, and all it does is gives you a consolidation down into a retracement, okay, and then creates a what? A lower low with a higher low in the stochastic. That's a type 1 bullish divergence in sync with the higher time frame. Suddenly now they have a much more reactionary response in price. We moved from that bullish divergence in here to a type 1 bearish, which is a higher high in price, lower high in the stochastic or indicator, and it caused a correction. Notice that we didn't break down and create a top in the market, it just retraced and consolidated. Type 1 bullish divergence in sync with the higher time frame. So now we have a more profitable position unfold. Now also notice that all these times where we got into consolidated overbought readings here, price just kept on going higher. Okay, we made a bearish divergence here where it was making a higher high. Type 1 bearish in the stochastic. All it did was consolidate and correct, and giving you another what? Bullish divergence, lower low in price, higher low in stochastics. Off to the races she goes, higher. Okay, so using bullish divergence and bearish divergence without having the higher time frame premise in mind is pretty much myopic. So you have to have it in perspective, and suddenly by using the concept of divergence with a higher time frame analysis, your indicators will become magical, and you'll see the examples that all of us as educators and teachers and authors like to use in our examples, but many don't go into the reasons as to why they were so effective. This is how it's done. You want to look at the higher time frame, directional bias, trade in direction of the market structure and market flow in higher time frames, trade off of key support resistance levels, and then suddenly your indicators and divergence will have a much more dramatic result on your bottom line. Now we've talked about type 1 and type 2 is now a trend following divergence, okay, and what that looks like is here we have a low in price and a higher low in price. But look at the comparable lows in the stochastic. We have this low here, which is this on price, and then this low in price is right here. So we have, and it may be a little weird for some of you guys that have never seen this before. Let me take this off here. It's not what I wanted to have. I got to set as array. Alright, and what we're noting is that we have higher highs, higher lows in price, because the market structure and market flow and directional bias is suggesting higher prices. So we have a up move based on higher time frame analysis. Price trades down, creates another low in price. But look what we've done here. We went oversold, true, but we went lower than the previous low reading in the stochastics. This is a trend following by nature type 2 bullish divergence. Okay, and by itself it's kind of cool. You can see how it lends well to continuation entry patterns. You have another one here. This low is higher than this low. Comparable stochastic readings is not reflected there, so we have lower in the stochastic, higher low in the price, and then we moved on, considering the higher time frame trend, it moved on higher. We have another type 2 trend following divergence, where this low in here is comparable to this reading in the stochastic. This low in price is comparable to this low. Okay, and now this actually is a much more powerful bullish divergence because you have both type 1 and type 2 nested together. Okay, and what that looks like is this: the low in price to low in price. Okay, so the most recent low, and we're not going to assume we've seen this price action here yet. We're looking at this reading here. And then you have the stochastic making a lower reading comparably. But now also notice that we had lower lows in this region here that were not met in the stochastic. So we have a type 1 divergence bullish within a type 2 bullish trend following. That is extremely powerful, okay? And that is a ICT 92 Stinger entry signal, okay? I gave you guys a bazooka by trading with just the standard type 2 trend following divergence, but this is a much more powerful entry pattern for oscillator use if you have a bullish market structure, okay, looking for a higher time frame price movement higher. Then you have a trend following divergence, which is a higher low in price but was lower reading in the stochastic. And then you have a bullish type 1 divergence, which is a lower low in price. Then you have a higher low in the stochastic. You have both entry patterns together. Okay, now here's the cool part. Okay, this is only going to be powerful if you include support and resistance. Okay, and we have all of this right here representing key resistance becomes broken support now. Okay, and also notice, okay, you have price trading at the 62% 62% retracement as optimal trade entry, and boom, we have a blast off in the Australian dollar. Okay, so you can see how blending these concepts together, you get a very violent reaction in price when you are trading with the higher time frame analysis in your favor using the divergence application that I use, which is type 1. And then you have also the trend following type 2, and it's usually commonly referred to as hidden divergence now, but again, I've said this before. These lows, this low here, this is a type 2 trend following, and that is actually a signal that was released by a trader named Nick Van Nice in the mid 90s rather, and he used to have a charting service called Commodity Trend Service, and he actually released this, and Larry Williams and I think are the only ones on the entire internet that give credit where credit is due, and it's Nick Van Nice that released this, what you know as hidden divergence, but it's actually type 2 trend following. Okay, so that's how I use oscillators and divergence, and how it can provide you excellent extrapolated moves in the marketplace. Time and price theory. Okay, so when and how do traders use indicators? Okay, well, a professional application would be to simply determine the high time frame key support and resistance levels. Higher time frames being the monthly, the weekly, the daily, and the 4-hour. And you can go down to the 1 hour, but nothing below 1 hour. But if you really want to focus on key support and resistance levels, you stick to the 4-hour and up. Now you want to determine market structure and trend on the higher time frames, and that more or less is the 4-hour and up. Okay, so 4-hour and daily, they're your best friends on that perspective on market structure and trend. Now, determine market flow on the higher time frames. That could be the daily, the 4-hour, and the 1 hour. Okay, market flow on those 3 time frames, that would be beneficial as well. And you want to look for indicators to signal a confirmation on a trade idea that you already had determined or anticipated without the use of the indicator. And you want to filter out contrarian signals that are counter your higher time frame analysis. You want to look for confluence or convergence with other tools at an area where you would reasonably expect a trade to form at a resistance level or a support level, and then go to your indicator to confirm what you may be anticipating in terms of price action. The indicator is the last thing you look at. What would that look like graphically? Well, this would be a price swing higher, and a correction takes place down into a key support level. The optimal trade entry noted by the blue lines, okay, this would be an area to expect a buy, and where the arrow indicates, this is where your bullish divergence would occur. And much like all of my things, if I just reverse the illustration, it'll accomplish the other side of the market. Okay, if price trades down Okay, and then we're in a bearish market environment. We're looking for lower prices anyway. Trades up into optimal trade entry at a key resistance level. This is when you would go to your indicators and you would see typically a bearish divergence. Okay, and that's how you would use an indicator. The indicator is always looked at last. All right, in summary, when you are first introduced to price indicators, they are most likely shown to you with the best possible examples on periods they worked well. Many books and teachers leave out the importance of using the proper indicator in the optimal market profile for that particular tool to be of any use. Using indicators by and of themselves is foolish. If you think that by plotting a mathematically derived line or similar addition to your charts will translate into your computer spitting out money, I'm afraid you are in for a rude awakening. Indicators, as we learned here, are best used in conjunction with price action analysis and optimal market profile applications. Then these tools will yield the results you have come to expect but likely have evaded you until now.